My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. This is one of my favorite series here on the channel. I like it so much because I get to interact with all of you. It's so interesting to read your emails and see how you're investing. Maybe you're here in the United States, or maybe you're international, you're somewhere, in Europe or in Africa or in Asia, North America, South America. It is so interesting for me to see how different people view and approach this topic of investing, and a lot of you are investing for financial independence, for FIRE, to reach financial independence and retire early through dividend investing. And that is exactly what my wife and I are doing. And so I absolutely love this part of the series, is interacting with all of you. And it's crazy. This is the 19th video that we've done on this series, and I absolutely love it. In today's Review My Pie, we're going to review 4 portfolios. The first is going to be from a 22-year-old here in the United States. The second, a 24-year-old in the UK. The third, a 46-year-old from the United States, and then the fourth portfolio, a 26-year-old from the United States. If you're maybe in your 30s or your 50s, in previous videos, I've shared different age groups. So I know that there's quite a few here in the 20s, but if you're interested in, a different age group and you haven't seen all of the videos, you can check back in previous videos here on the channel where I've reviewed different age groups. I try to keep it every video a little bit diverse, where there's, a little bit of something for everybody. I don't pre-script what I'm going to say in these videos. I don't pre-read the emails. I don't pre-read or pre-review the portfolios. I'm reviewing them live as I'm recording the video here. The timestamps are in the description below, and the portfolio links, when there is a portfolio link, I do share it in the description below. So if you want to check out that, you're more than welcome to do so. And as always, everybody, I'm just a random dude here in Texas. I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. So I've been investing for 15 years, and I've noticed that investing has changed and evolved over these last couple of years. When I first started investing, I think I was using Scottrade, which was acquired by TD Ameritrade. You have these traditional brokerages in Schwab and Fidelity. And back, when I started investing, I had to pay $7, $8 for every purchase and every sale. And so I was very intentional with every single purchase and sale that I made. It wasn't just, okay, I'm going to buy a little bit here. There was no fractional shares. It was very, very different. And I think about it today, everybody that is in their early 20s, how lucky, or you could use the word luck, blessed, privileged, whatever word you want to use, it is so incredible to see how things have changed, in most cases, all for the better. I mean, for your average investor, it is so much better to be an investor. We call them retail investors, your regular investors, you and me. It's so much easier to do it yourself and not have to rely on a portfolio manager or anything like that. You can do it yourself. I am so grateful for all the resources and innovation that has come throughout the last couple of years. The free trades, the fractional trades, for, average investors, you and I, to, succeed in the stock market. But despite all of that, it's still challenging. Investing in the stock market is not easy. Sometimes it kind of feels a little like this.
童子拜观音的打法。有这一招。
I love that. All right, the first portfolio is from Sebastian. He writes, "Hello, Jake. Hope all is well and safe. Before I talk about myself, I just wanted to voice my appreciation for your work. Your videos were the catalyst for my journey to investing for my future." Sebastian, thank you so much. I really, really appreciate you saying that. He continues writing here, "My name is Sebastian. I'm 22 years old, and I'm currently a full-time student. I'm investing $100 a month from the money I have saved up from the jobs I've worked in the past, but plan on increasing this as I join the workforce. I have cut all expenses considerably to make this as smooth as possible." And then you write down here, I believe, your goals. "So I'm investing on M1 Finance in a taxable account. My goals are to one day live off of the passive income I would be making from the dividends. I want to invest for slow growth over time. I have a time horizon of at least 30 to 35 years. I'm committed to waiting this out for the long run, as I am aware I'm in a good position due to my age. I currently have $2,000 invested. I would like to hit at least $40,000 a year from dividend income by 2060. I'm very new to investing. I don't have many holdings, and so any help, criticism would be greatly appreciated and welcome. Here's the pie once again. Thanks for the work that you do. I believe, Sebastian, that you sent over an updated email with an updated link. All right, Sebastian, this is so great. You're 22 years old. You're already investing $100 a month while being a full-time student. This is incredible. Now, I think if I look at my own experience and I look at others, around me, I think in your 20s, it's all about setting yourself up for success. In your 20s, you're typically not going to make the most amount of money. You might get, depending on your degree or your focus, the 20s are really about cutting your expenses, saving on your expenses. And then towards your 30s and 40s, that's really where you're going to be making money from your day jobs. And your 20s are so great. You got to be a little bit humble, I guess. You have more time, but less money. And then when you get older, traditionally you have more money, but less time. But that's why we strive for financial independence, so that we can choose what we do with our time. But I think in your 20s, you are off to an amazing start. I am so jealous. I wish I would have been as disciplined at 22 as you are. Now, I love the fact that you're already focused on time horizon. 22 years old, you have a 30 to 35 year time horizon. I think you might be pleasantly surprised that you're going to be able to reach your goal much sooner than in 30 years. If you're starting at 22 and making $100 or saving or investing $100 a month, and you haven't even entered the workforce, if you can kind of do those three things that I always talk about: cut your expenses, stay out of consumer debt, and look for new ways to make more money, you are going to be surprised by how fast this is going to snowball. And you might be surprised that you might even get there much, much sooner. Okay. And $40,000 a year, what I would highly recommend you take a look at is understand inflation. 30 years is a long time. In 30 years, your $40,000, your buying power is going to be much lower in 30 years. So $40,000 today, I could live off of $40,000 if I had low expenses and I didn't live in a high cost of living area. But in 30 years, $40,000 is not going to be a lot of money. So very, very important that you understand inflation and that's why investing, especially in the stock market or investing in general, is so powerful. It's a good way to fight against inflation. So let's take a look at your portfolio. Your portfolio over the last 5 years is up 177%, not considering the reinvestment of dividends. So if you consider the reinvestment of dividends, this would be significantly higher. So you're getting pretty comparable results to the S&P 500. You have a dividend yield, a current yield of just over 1.5%. You have a very low expense ratio, and you have 43 holdings. Okay, this is actually, the numbers here are good. You said you have a 30-year time horizon. This is actually really, really good. When it comes to dividend time horizon, if you go over to the channel here on the videos tab on my channel, if you scroll down here and you look at this video, Dividend Starter Pack, how to invest based off of your time horizon, this is a great video to kind of see, what kind of holdings should be in a 10-year time horizon, 20-year, 30-year, and 40-year. And I kind of share what is important to me when considering the different time horizons. So I don't know if you've already seen that video, Sebastian, but this is definitely something that you will want to check out, as well as anybody that's in a similar situation. You'll want to check out this video. This is really, really, really important when it comes to time horizon. So let's take a look at your holdings that you have in here. You have broken it up into 9 slices with technology at the highest. You also have some ETFs. You got your consumers. Now with consumers, it could be consumer discretionary or non-discretionary. So we'll take a look at that. Industrials 13%, healthcare 13%, real estate at 8%, financials at 8%. Communications at 5%, and utilities at 3%. So right off the bat, when it comes to the sector allocation for your time horizon, this is really, really good. Very, very good. Actually, great, in fact. For a 30 to 35 year time horizon, this is great. And I mean, let's be honest, Sebastian, 30 years, a lot can change in 30 years, right? That's longer than you've been on this earth, right? So be prepared. It's great to have a plan. It's so important to have a plan, but understand that things in your life may change. And I think focusing on staying flexible and I think that's really, really important, because there's so many things that could happen in 30 years. Like I mentioned, you might be pleasantly surprised that you might reach your goal of 40,000 much sooner than 30 years. So let's take a look at your first slice. You have 6 holdings in here. You have Microsoft, Apple, Visa, MasterCard, Texas Instruments, and ADP. These are all amazing, amazing technology companies. For those of you that have been following the channel for a while, you know that I work in the technology sector. I've been in the technology sector for about 10 years now. I've worked at some of the largest companies, anything from like Google, Microsoft, Oracle, these type of companies I'm very, very familiar with because that's where I've been working. And so I've seen how technology has changed over the last, just couple of years, right? And so when you're investing for the long term, I think focusing on quality, especially if you never plan on selling these companies. Technology there's always disruption in technology. And so if you're investing for the long term, making sure that you're investing into companies that have economic moats, competitive advantages, and that are innovating is so, so important. Microsoft, Apple, Visa, MasterCard, Texas Instruments, and ADP, these are all really, really great companies. You can invest into this portfolio and these technology companies and sleep well at night. There's going to be other companies out there like your Square, your PayPal, these other, fintechs, your disruptive companies out there that they pose a threat to Microsoft, to Apple, to Visa, etc. But Microsoft, for example, is such a well-managed company. They are innovating so fast. The way that, I mentioned that I work in the technology sector. I'll share something really, really quick. Great technology companies create products and services that are sticky. And what I mean by sticky is it's not easy for their customers to just churn. What that means is buy their software and then leave. Companies like Microsoft and Apple are very sticky. When they acquire a customer, that customer is pretty much in bed with them. They're there working with them for years, and they have multi-year contracts. And that's what makes technology companies so great. And so if you're a new investor and you're looking to invest into technology, look for technology companies that are sticky. And you can Google it, sticky technology companies. That's a term in the technology sector that is well known. And so that's really, really important, is sticky when you're looking at technology companies. There you go. You don't have a lot of people on the internet talking a lot about that because a lot of people don't work in the technology sector. And so that's something really, really important to consider. Okay, cool. So next slice here in ETFs. Your ETF slice is performing very, very well. Historical performance. Let's take a look and see what you got in here. You got DGRW, beautiful. You got VTI, VIG, VOO, and DGRO. These are so great. You must be following my channel or something. I don't know, but this is absolutely great. I love DGRW in here because it focuses on dividend growth in a different way, and I've shared this a couple of times. It focuses on future returns, not historical returns. VIG looks at historical dividend growth performance, whereas DGRW looks at future performance or future potential. And that's why you'll see with DGRW, it has a slightly higher expense ratio, but you pay for that in the quality of how this ETF is being, I guess you could say, how it's screening companies to include inside of it. And you got VTI, it's great, total stock market, VIG, VOO, and DGRO. Now this is cool. So with VIG and DGRO, this really depends on your time horizon. With your time horizon, I think this is fine. With anybody less than a 15-year time horizon, I would not recommend VIG. I would recommend DGRO. VIG is a little bit, it's kind of like the S&P 500, I guess you could say, but it doesn't have a very high dividend yield. I mean, if you pull it up here, it has a 1.5%, whereas DGRO has a little bit of a higher. And so if you have a shorter time horizon and you're looking for that dividend growth, that traditional dividend growth ETF, I really like DGRO over VIG. If you have over 15 or 20 years, VIG is great. But as a whole, these are all great. The sector allocation is fine. I think it's great. Let's take a look at your consumers. You got 9 in here. You got Starbucks, Pepsi, McDonald's, Home Depot, Lowe's, Nike, Costco, Target, and McCormick. These are all really, 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 really great. So if you've been following my channel, I used to have McCormick in here. I used to have Nike in here. And the reason why I took them out of my portfolio is because my time horizon changed from 10 years down to 5 years. And with McCormick, these are such great companies. If you're in your 20s, McCormick, Costco, Nike, Starbucks, these companies are amazing for a longer time, investing time horizon. The great thing about these companies is you're getting the best of both worlds. We talk about dividend growth investing. McCormick is a growth company. Costco is a growth company, but they're dividend growth. They pay a lower starting dividend, right? When you look at McCormick, it has a little over 1%. You look at Costco, it has less than 1%. But then if you look at, for example, a Pepsi is not growing as fast as a McCormick or a Costco. And so maybe what you even could consider is increasing McCormick and decreasing Pepsi when it comes to your portfolio, simply based off of your time horizon. Okay, but the consumers are great. Let's see, industrials, you got 6 in here. You got 3M, Waste Management, yes, Lockheed Martin, Union Pacific, Honeywell, Caterpillar. I own every single one of these companies in my portfolio. I would recommend maybe lowering 3M and bumping up Caterpillar, Honeywell, and Waste Management. You can keep it there, 20%. I would, with your time horizon, you'd be better off, in my opinion, lowering 3M and upping Honeywell, Caterpillar, or Union Pacific, for example. But other than that, all of them are great. I own them all in my portfolio. It really just comes down to your target allocation. You don't for everybody that is watching this video, something that I hear time and time again is people overstress the target allocation. Yes, it is important. But it's not, the end of the world if you're off by a percentage or 10%. Like it's not going to impact it so much, right? I think so many people get, stuck up on, okay, how do I get the target allocation exactly perfect? I don't think I don't think perfect exists when it comes to this. You want to set up an ideal allocation for your current plan and your goals, and those goals may adjust and change over time, and then you can change your portfolio over time. But don't overstress it. But yeah, with this one, it is a little nitpicky. I would reduce 3M and up one of these down here. Let's take a look at your healthcare. You got 5 in here. You got Stryker, Medtronic, Johnson & Johnson, United Healthcare, AbbVie. These are so great, and I love these 2 companies. These are two of my favorite growth companies in the healthcare sector, Stryker and Medtronic. These are such great companies. They are great dividend growth companies. For your time horizon, I love seeing this. This is so great. Johnson & Johnson, also really great. United Healthcare, great. AbbVie, also great. Very great slice. Real estate, let's see here. You got American Tower, you got DLR, and you got Realty Income. Okay, yeah, these are great. Another one that you could add in here that I always talk about. This is Prologis. It's an industrial REIT. It's a growth REIT. I would recommend taking a look at that. And maybe if you wanted to add that, you could. You could also look at maybe reducing, Realty Income, maybe if you wanted to, and add that in there. But my favorites are American Tower, also like Crown Castle. I love Digital Realty. I also like Equinix. It's another data center REIT. And I really like Industrials and Prologis. Really great. Okay, cool. So financials, you got JP Morgan, Goldman Sachs, and Aflac. Okay, so with this slice, I would encourage you to maybe take a look at some other financial organizations. JP Morgan is great. Goldman Sachs is great. I also like Standard & Poor's, ticker symbol SPGI. Take a look at that one. I also like T. Rowe Price. T. Rowe Price just increased their dividend an insane amount. I also really like Aflac as well. I do like Aflac. So take a look at SPGI, take a look at T. Rowe, and maybe consider lowering the traditional banks a little bit. Maybe this is a little nitpicky, but looking at those other growth ones, especially with a 30-year time horizon. Communications, you got Disney, great, Verizon, and Comcast. Yeah, this is absolutely fine. You could even swap Verizon and Comcast. It probably would be better. I would, in my opinion, I'd increase Comcast and I'd lower Verizon. I put Verizon, just randomly, if I was in this position or investing for somebody that, maybe a family member that had 30 years, I put Verizon maybe at 10%. I would then jump up Comcast and have Disney and Comcast be the highest. Utilities, what do you got here in utilities? You got Nextdoor Energy, American Waterworks, and Southern Company. These are so great. When it comes to the target allocation, I would not change a single thing. I think this is great. Sebastian, thank you so much for sending over your portfolio. I dropped a few nuggets of really helpful information. I hope that it was helpful, especially with the technology part, things to think about. This is a great portfolio. This is a type of portfolio that you can dollar cost average into for the next 30 years and not lose a night of sleep. Thank you so much for sending over your portfolio. All right, the next portfolio here is from Dale. He writes, "Hi Jake, my name is Dale. I'm 24 years old and from the UK. I started trading in July of 2020 and began to watch your videos shortly after I started off doing penny stocks and merger plays. But as soon as Trading 212 is a brokerage, it's not available in the US, and Auto Invest Pies, I became extremely interested in making pies. I'm a full-time student for the next 3 years, currently adding 500 pounds to 750 pounds every 3 months to my pies as an even amount of the growth pie I want to use for a down payment or for a large lump sum for a house, about 300K in total." Okay, great. "And a dividend pie purely for fire. Any feedback would be appreciated as I'm unsure of the percentage allocation." Okay, so we're going to take a look at the allocation. So your questions that you write down here is around my percentage allocation, if it needs to be altered. Are these good stocks to hold? And then will you achieve your goal maintaining or still paying 500 pounds to 750 every 3 months? And should I focus more on growth than on the dividend pie, and what sort of return would I be looking at as a rough estimate? P.S. Thank you so much for posting such interesting and knowledge-worthy content. I personally learned so much from you, and I'm looking forward to learn more. Kind regards, Dale. Well, Dale, thank you so much, man, for sending over your portfolios. I think there's a lot of stuff to unpack here, and let's take a look at it. So really what it comes down to is, what is your goal when it comes to investing? Are you investing to purchase a house, or are you investing for dividend income? Because these are they're pretty different, right? It's kind of challenging to have when you're looking for dividend growth, you can invest into great companies like Microsoft that pay a dividend that are also really great for capital appreciation. But it really comes down to, what is your goal? Are you planning on never selling the shares, or are you planning on buying low and then selling high at a future date? That's really, really what it comes down to. And I hope that the channel and the videos on my channel have helped answer a lot of those questions, because that really is what it comes down to. What's your goal? When it comes to your goal, I think, you have two portfolios here, and I think that is really, really important, because if you're investing for, capital appreciation, it is very different than investing for dividend growth. With dividend growth, it's really about the compound, the snowball effect, where you're compounding and you're reinvesting the dividends over a longer period of time. If you're investing for capital appreciation, it's all about buying at the right time, at the right price, and then selling at the right time when you need the money. So they're two different approaches. So with that out of the way, I think when it comes to that, with buying a house with 300K with 250 a month, 750 every 3 months, I think you can definitely achieve that, but it's going to depend on the type of investments that you have in your portfolio and your time horizon. It could take, 10 years. It could take 30 years. It really comes down to how you set up your portfolio. And we'll get to that here in a second with the allocations here, okay? And with your question here, are these good stocks to hold? Now, if you're asking this question, are these good stocks to hold? I would encourage you, from my experience, don't hold stocks. If you're asking anyone, hey, is this a good investment or is this a good stock? It means that you don't understand, and that's okay. I'm not insulting you. It's very, very much okay. If you don't know what you're investing in, don't invest in it. That's my recommendation there. If you're asking, hey, is this a good investment? It means that you haven't done your own research and you don't necessarily know what you're getting yourself into. And so what I would recommend to anyone in that situation, before you dive in and start being a stock picker, why not start with index funds? Why not start with great ETFs that track the broader stock market? And as you learn more about the stock market and investing, then you start dabbling in and picking your own individual stocks. That is so, so important. If you ever find yourself asking the question, is this a good stock? You're in a bad place. You don't want to invest into something that you don't understand. The reason why is, when the market drops 30%, 50%, and you don't understand that business, you're going to hit the oh shit button and say, all right, I'm going to sell. I'm out of here. Because you don't understand the business. You don't have conviction in the stock, and you're going to sell it. So that is so, so important. If you don't understand the company, don't buy it. Now, I think we already covered the 500 to 750 in 3 months if you'll reach your goal there. It really comes down to your time horizon. And I would recommend you use the dividend reinvestment calculator that I've shared on the channel here. You can check in previous videos. I've gone over that. I'd highly recommend that. And you play with the calculator and it'll show, how long it'll take you to reach your goal. Should you focus on the growth pie or the dividend pie? Really, once again, that comes down to your goal. Are you planning on never selling? What is important to you? What is your time horizon? That kind of stuff. So let's take a look at your first slice here is your growth slice. For the next 5 to 7 years, you have 50 holdings in here and it looks like they are all equally weighted at 2%. Okay, 2% is great. Like when it comes to diversification and risk aversion, 2% allocation in an individual stock is a good amount. So this is your growth slice here. You got Microsoft, great company, Amazon. And I recommended that you stick with ETFs, but if you don't want to stick with ETFs, and the next thing that I would recommend is then focus on companies, businesses, brands that you understand, right? You've heard of Microsoft, right? Okay, you've heard of Amazon, you've heard of Tesla, you've heard of Facebook. Focus on companies or brands that you understand and invest into those. If you're dead set on investing in individual companies and you're a new investor, I would recommend sticking with brands that you understand and not dabbling into, maybe companies that you don't understand. Because once again, when the market is correcting and diving down, your emotions will take over, especially if you're a new investor. That's how you lose as a new investor, is when the market plunges, you're not confident in your investments and then you sell out of them at the wrong time. That's how you lose in the stock market. All right, so you got a clean energy ETF in here. That's fine. Coca-Cola. So why is Coca-Cola in your growth pie? Coca-Cola should be in your dividend slice. Coca-Cola is a great company. It's one of my largest holdings in my portfolio. I would never purchase Coca-Cola with the anticipation for it to double in 5 to 7 years. Coca-Cola is definitely not a growth company. I would reconsider Coca-Cola. And just because it has a great brand doesn't mean that it's a great growth company, right? So Coca-Cola definitely is not a good fit in this growth slice, in my opinion. Google, absolutely a growth company, love it. AT&T, no. AT&T is not a growth company. All right, Dale, let's take a look at this here really quick. Does this look like a growth company to you? No, this is not a traditional growth company. This is an income company. This is for those that are nearing retirement and are looking to retire off of their portfolio. This is not a capital appreciation play in the next 5 to 7 years, okay? So AT&T, this would be a great fit for your dividend slice, not your growth slice. Let's take a look here. You got AMD, great growth. AbbVie is actually a great growth healthcare company. It has a great dividend, but it's a growth dividend company. You got the Vanguard, Financial Times, Stock Exchange 100 in Great Britain, great. American Tower, great growth company. Beyond, Shopify, great. Alibaba, great. NRZ is more of an income play. It's a REIT. Okay, Intel, Nike, great. Yeah, so you have Snap, Square, this is what I'm talking about. Stryker, these are great growth companies, really great. So it looks like you have a little bit of a mix. Etsy, growth, yes, great. So yeah, you have some really great companies in here. You even got, yeah, there's some great companies in here, but what I would recommend is first do your research on, what really makes a great growth company, right? And understanding what constitutes as a growth company versus an income-oriented company. When I say income, it's kind of like, your AT&T that pays a high dividend that is growing slower. They maybe have a larger market cap, so they're not growing year over year as fast as like a Tesla or an Amazon. Now let's take a look at your fire slice here. You got Microsoft, you got Realty Income, Johnson & Johnson, 3M, AbbVie, and Pepsi. Yeah, these are all really, really great companies for a 20-year time horizon. Realty, okay. Pepsi, Qualcomm, yeah. McDonald's, IBM, yeah. Store, Intel, Waste Management, love it. Nintendo, great. Oracle, yeah, that's fine. Vodafone, okay. You got the S&P 500. In my opinion, Dale, what might be not the worst idea, if trading 2 and 2, I've never used it. I've heard it's great though from a lot of you. What you may want to consider is bumping up this to a higher percentage in the beginning. And I would recommend this for any new investor. Any new investor that you're maybe a little bit unsure about your ability to pick the right stocks and set up your portfolio. You can always change it later. In the beginning, I would always recommend putting this, your S&P 500 ETF, at the highest allocation. And then slowly, as you grow as an investor and as you learn more, then, update the portfolio accordingly. And it's also great for your emotions and, for everything. So I would highly recommend that. You got your Honeywell, your Verizons, American Tower, Pfizer, great, Duke, FRT. This is a REIT that nobody talks about. This is a dividend king. It's been paying a dividend for over 50 years. It's a real estate company. It's a REIT. Really, really good. Altria Group, great. NRZ, great. Lowe's, Kimberly-Clark, Chevron, Clorox. Yeah, these are all really great companies. So you've obviously done your research. One thing that I'd ask you, so take a look at AG&C. This is what I would like you to ask yourself. Ask yourself, do you know what AG&C does? If you can't answer what AG&C does, if you don't know how they make their money, you should not invest into AG&C. This is a mortgage REIT. This is one of the riskiest forms of REITs, right? They're very tied to interest rates. If you don't understand this, there's no shame in it. Take it out of your portfolio. I mean, it's just in me, from my personal experience, what I would do if I was in that situation, if I didn't understand how the company made their money, I would take it out. There's no reason for me to invest in it. There's so many other great companies. I don't need to go wide and invest into everything when I don't have to. So sometimes more is not better, in this case. So, but yeah, you have a lot of great companies in here, but there's no shame at all to having a higher allocation in ETFs. No shame at all. In fact, if you're a new investor, I would highly encourage it. You could have 50% in the S&P 500 or 80% when you first start out. And then as you grow, you can slowly adjust the portfolio. That's my opinion. There's a lot of things that you need to consider. It's obviously personal for every single person. But those are the things that I've learned over the years, and I hope that was helpful. Hopefully it gives you something to think about. But Dale, once again, thank you so much for sending over your portfolio. All right, the next portfolio here is from Ivan. Ivan writes, hello, Jake. My name is Ivan. I'm almost 46 years old, and I started a dividend portfolio this November in 2020. My goal is to retire in 10 years with the major dividend income possible. Okay, cool. Let's do it. I'd like to invest at least $2,000 every month or more. Please find attached my portfolio for your review. Thanks for your help. Best regards, Ivan. All right, very cool. Let's take a look at it, Ivan. Alrighty, Ivan, so it looks like you have 23 holdings. It doesn't look like you filled out everything here all the way. Maybe you're just starting or just started setting it up. It doesn't look like you have the allocation or the weighting set up either. So what I'm going to look at is I'm just going to look at the companies that you have here, and then I'm going to see, okay, hey, maybe consider based off of your goals and maybe your time horizon, kind of look at and see, okay, which ones, if I was in your shoes, which ones I personally would be prioritizing. So you got AbbVie up here, you got Realty Income with O, you got Simon Properties, you got SPHD. SPHD is pretty popular. A lot of people on YouTube like this. It's a monthly dividend ETF. It has a little bit of a higher expense ratio. I think it's fine. It's not my favorite ETF, but I think it's fine. You got Store Capital, you got AT&T, you got Disney, JP Morgan, you got Foot Locker. I don't see Foot Locker a lot. That's interesting. Okay, cool. You got IPR, you got Qualcomm, you got Duke, Johnson & Johnson, JP Morgan. You got JP Morgan twice there. Okay, so you got 22 holdings. You got Pepsi, you got Kimberly-Clark, 3M, Waste Management, Pfizer, Aflac, Caterpillar, Verizon, Home Depot. This is right up my alley. All of these tickers, I'm familiar with these. These are all great companies. With this type of portfolio, it looks like you have the majority of it is focused on a kind of a 10-year time horizon, 10 to 20 years, I guess you could say, right? With some of them, there's kind of a mixture. But like when you look at Duke, for example, Duke, Pfizer, you look at Verizon, those kind of companies, AT&T, I'm trying to think here, Realty Income, like some of these companies, these are really, really great with a shorter time horizon, but you also have great companies in there like Disney. You have Foot Locker. I'm kind of on the fence of Foot Locker simply because, you know, of how retail is evolved over these last couple of years. But you have some other growth companies in there as well. You also have Aflac and Caterpillar. So really when it comes to this type of portfolio, I really like that you have well-established brands. You have brands in here that people know. You probably, you know, see AT&T stores on, you know, where you live. You probably bank at JP Morgan. You probably are a consumer of Johnson & Johnson products. I like the fact that you're focusing on companies that are well-established. They have good brands and people recognize them. And so what it comes down to is setting up your portfolio based off of your time horizon. And that's what I mentioned earlier in the video. When you're building out your portfolio, the percentages, like you don't want to stress too much over them. Like you're not going to get it perfect. There is no perfect, but there's kind of a target that you want to aim for. And that's why, once again, why I recommend this video so much. The Dividend Starter Pack, how to invest based off of your time horizon. I'd really, really recommend you check out that video. But yeah, as a whole, you know, when it comes to the names in your portfolio, I think it's so important that when you're investing that you understand the companies that you're investing in. If you have to ask the question, well, is this a good investment? It's probably not a good investment. So make sure that when you're investing in your portfolio at 46 years old or 46 years young, in my opinion, you know, that you have your plan, and you're right at that age at 46 where what's really, really important is in which account you're investing in. At 46, you really want to focus on maximizing your tax sheltered accounts. Depending on when you plan on retiring, at that age, really what matters even more than the individual companies is where you're investing, in which account type. So really, really important that you're doing your research and you're understanding, you know, what is an HSA? What is a Roth IRA? What is an IRA? What is a Roth 401k? What is a 401k? All of those different accounts, that's really where you should be focusing your energy, as well as obviously getting the right investments, but where you're parking your money and investing your money. So important. Ivan, thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio from Bishop. He writes, "Hi Jake, I'd email you my portfolio to put into one of your videos in the future, but I've ended up making some very important changes to my holdings that will help me in the long run. If you're able, I would love for you to take a look at my portfolio and give me your honest opinion of it. Again, I am 26 years old and I will be contributing about $400 to $600 a month depending on my current finances. I have a 401k through my employer and they do a match up to the 6%, but I am contributing 15%. I'm hoping to retire at least in my mid 40s to early 50s. Thanks for your input and I love your videos. Sincerely, Bishop." Well, Bishop, there is so much great stuff in here and I want to touch on a few things. So you're 26 years old, you're already contributing almost up to $600 a month. This is absolutely great. As I mentioned before on the channel, make sure you got those three things in check, especially in your 20s. You have low consumer debt or no consumer debt, you have low expenses, and you're looking for new ways to make more money. Those are the three things that you really, really want to focus on. You have a 401k through your employer, and they do have an employer match, but you're also contributing 15%. Now, this is so important for everybody that is watching the video. This is one of the things that my wife and I struggled with the most when we were planning on retiring early. When we first started on our financial independence journey, we didn't really know if it was going to be possible to retire before the age of 59 and a half. Like we knew that we kind of could make it work, but we didn't really have a dedicated plan. And so like you, I was maxing out my 401k, I was doing all of that. And there's some tricks in the FIRE movement that you can use to max out your 401k. You can do a Roth IRA conversion ladder. There's so many cool tricks that you can do with the tax laws that we have here in the United States. But what I understood is I could actually retire much sooner than I originally thought. And it really kind of made me rethink how I invest into my individual portfolios and which account type. So I'm going to share with you a few different things, a few different videos that I would recommend you watch, especially on this topic. Okay, so you're looking to retire in your mid 40s to early 50s. So here's the thing. If you're investing for dividend, dividend investing, your account types are very, very important. If you're doing the traditional FIRE movement, where you invest into VTSAX, VTI, ETF from Vanguard, and you're doing it through traditional FIRE movement, 401ks are remarkable. They are so amazing. They're great. If you're doing it through dividend investing, what I'm doing, it's a little bit different. My wife and I, we don't max out our 401ks. We invest into our 401ks up until the employer match, nothing more. Okay, and so let me share with you a few videos. So when it comes to the different investment accounts and the order in which we invest, I would recommend you take a look at this video. The best investment accounts for dividend investing to retire early. I break down every single account and I give two examples. Retiring at the traditional age of 59 and a half, and which order we would invest in that case, and the second scenario of retiring early with dividend investing. This video right here can help you out a lot when it comes to understanding the different account types. The second video that I would recommend that you watch is this video right here, how to pay 0 taxes on your dividend income in early retirement. Now, this video will surprise almost everyone that watches this video. Most people will think, okay, well, he's just going to talk about a Roth IRA. No, I actually don't. And so this is very, very different. And I would highly recommend, if you're in this situation, watch this video. You will learn so much from this video. Once I understood this, it made everything so clear. Okay, this is one of the, honestly, this is one of the best videos that I've made on my channel when it comes to taxes and investing for financial independence and retiring early. All right, Bishop, let's take a look at your portfolio. Your portfolio is up 84%. That's really, really good. Your dividend yield is a whopping 6.4%. Holy cow. You have a high expense ratio. Okay, so your expense ratio is actually on the higher end. I personally, that's right at my comfort zone, like right on the border. Anything above that, I would say, hey, we have a problem. But with that, I think you're still on the edge. You could still make it work. And your portfolio only has 9 holdings. Let's take a look and see what you got here. Okay, so you have the bulk here into ETFs. You have SPYD, you have QYLD. I need to make an entire video on this cover call ETF. Everybody keeps asking me what my opinion is on that. You also have the BlackRock Science and Technology Trust. You have Verizon. You have AT&T. You have Newt. I'm not familiar with this one, to be honest. I'm not as familiar. I'm not as familiar with this one either. So these two, I can't really give you any real opinion because I have not researched these. And this one as well, I'm not really familiar with this one as well. I am familiar with Kinder Morgan. Okay, that's great. Let's take a look at this and let's dissect a little bit of some things to consider. The very first thing with SPYD, SPYD is an amazing ETF. It has such a great dividend. It has a really high dividend. It has great performance. It has a fair, expense ratio. It has a low expense ratio, but the dividend yield is amazing. But here's the kicker with SPYD. It's not just regular qualified dividend paying companies in here. There's a good percentage of real estate investment trusts in this ETF. So this ETF is taxed less favorably than VYM or SCHD, right? This is not taxed as favorable. And if you have this in a traditional account, you have to understand you will be paying higher taxes. That's where this other video right here, the how to pay 0 taxes, that's where this video comes into play. But once again, that is something really, really important to consider when you're investing in a dividend growth strategy or a dividend strategy, is the tax implication that comes with it. So let me share an example of why I don't invest into SPYD today. So my wife and I, we're looking to retire in the next 5 years. Today, while we're growing out the portfolio, we don't have SPYD in there. My plan is right before we reach early retirement, about 1, maybe 2 years before we retire early off of our dividend portfolio, I do plan on adding SPYD to the portfolio. But that's not for a couple of years. I want to have the most favorable tax treatment while I'm earning more money now. In early retirement, I'm going to earn less money. I'm going to pay less taxes, and that's why I will add SPYD later. Now with this covered call ETF, I've done a little bit of research on it. I think it's completely fine. I think if you've watched my video, I invest with the core and satellite methodology, where you have your core holdings make up about 80% of your portfolio, and then you have your satellite, holdings, those, to the moon type investments, where they only make up a very small percentage, right? And so I think having an ETF like this, and I'll share an entire video on this and the other cover call ETF in the JP Morgan JEPI ticker symbol cover call ETF. When it comes to these type of investments, these would make up my satellite position. Here, let me show an image here really quick. It'll make it a little bit easier. So what I mean by core and satellite, the core makes up the bulk of my portfolio. Once again, about 80% of my portfolio, that's my Johnson & Johnson, my Kimberly-Clark, that's my Coca-Cola, my Pepsi. Those are my core holdings. But also I have other holdings in here that are called my satellite holdings. These are like my Costco, my Target, my Stryker, my Medtronics, these other companies that are higher flyers. These are higher growth companies. And this could also be, for example, if it could be Tesla, right? I could have a small percentage in Tesla. I could have a small percentage in Bitcoin if I wanted to. In terms of full disclosure, I don't invest into Bitcoin, like I don't. But that's an example of a satellite holding. So if you're an investor, it's important to understand this core versus satellite. And the most important thing is that you have your core. If you have your core, then you could be like, Jim Cramer on Mad Money, and you could have your Mad Money and you could invest into like these other, satellite positions. And that's how I view these covered call ETFs. They would never make up part of my core holdings. They would never be the largest holdings in my portfolio, but I would be very open to holding them as a satellite position that I would not have more. One satellite position would never make up more than 5% of my overall portfolio. Right? And so that's how I view these covered call ETFs. All right, now let's take a look at BST, BlackRock Science and Technology Trust ETF here. Now, when I look at this, let's look at the historical performance. I mean, this performance is incredible. I mean, and it's paying a dividend every single month, it looks like. I'm not as familiar with this ETF, but looking at the performance, it has incredible performance, and it's paying a monthly dividend. Like, this is really, really interesting. The only thing that I don't like about this ETF is the expense ratio. The expense ratio is so high, but I mean, you look at this performance, a lot of ETFs have a high expense ratio and they don't perform. This may be an outlier. This may be different. I'm looking at the performance here. This is absolutely incredible. So this may be something where you're like, you know what? Okay, I may consider it, but let me share why this is not something that I personally would invest in. And it's because of the expense ratio. Over time, the expense ratio eats away at your total return. So if you go over to an expense ratio calculator, I like the one here from NerdWallet. Let's take a look at an example of why expenses matter so much. All right, let's just use the example that you had $10,000 invested in it. This is obviously hypothetical. And let's say you were contributing $5,000 for the next 30 years. Now, I know this is more than what you're investing today, but as your income increases, you're going to be investing more. So let's say you only invested $5,000 for the next 30 years, and let's just assume those metrics. Let's say the rate of return was around 10%. Let's just keep it at 10%. And let's say you kept the expense ratio as it is here with this ETF. And if you were to calculate this, you're going to be paying over the next 30 years, you're going to be paying $200,000 in fees to this ETF. Yeah, you're going to get great value from this ETF, but it's going to cost you $200,000. So this is what you're getting with this BlackRock ETF, for example. Now, let's say, for example, you didn't invest into this ETF, but you invested into the S&P 500. Let's say you invested into VOO, and the rate of return is about the same, right around 10%. And let's say you invested into VOO, what that would look like and what the difference would be. So you're seeing here, with the old one, you got $200,000 in fees. What would it be like if you just invested in the S&P 500 from Vanguard? Your fees would drop to $6,000. You see the difference there? And you see your net worth? You're actually getting much more in terms of a total return from the S&P 500. So you asked for my honest opinion. This is my honest opinion. Fees are are evil. Like they eat away at your total returns. The only person or party in this case that wins when it comes to fees are the fund managers. The ones that create and manage these ETFs. They're the only ones that win. You as the investor, you don't win. And that's why fees are so important. And that is why I don't invest into those type of ETFs, even if they have great returns, right? I think it had like 300% over the last 5 years. The fees eat away at your total returns and you as the investor lose. That's why I don't invest in them. All right, let's take a look at the others here. You got Verizon. This is a great high dividend company here I own in my portfolio, AT&T as well. Once again, I'm not going to speak to the others. I think, with your time horizon, let's say you have 20 years, right? You want the dividend income fast, but you have to think just beyond the current dividend. Unless you're looking to retire in the next couple of years, you would be better off investing for dividend growth. Yes, you're getting this sexy 6.5% dividend yield today, but you're not investing enough to be able to live off of it today. And the tax burden is probably going to work against you. It's not going to be working in your favor. So that's where I would encourage you to really understand, okay, what is the power of dividend growth investing versus just dividend income today? If you're not looking to retire or use the dividend income today, you would be, in most cases, better off focusing on growth. And what I would recommend you do is go on the channel here and take a look at the dividend reinvestment calculator that I've shared a few times and play around with the dividend reinvestment calculator and see what it would look like compared to investing for dividend income today and, with a 20-year time horizon or investing in a dividend growth strategy for the next 20 years. You asked for my honest opinion. I shared it. Make sure that you understand the importance of how fees really play a role in your portfolio over the long term, and really understand that high dividends today are not always the right approach. It really comes down to your time horizon. Thank you so much for sending over your portfolio. Thank you so much, everybody, for watching. I hope you all have a great week, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.